Right, let's talk about what's really happening in the financial world right now, because the warning signs are flashing bright red. It all comes down to something called credit spreads. Think of it as the extra interest risky borrowers have to pay compared to super safe ones. Like the government, normally, this spread is tiny, maybe 3 to 5 basis points. But just recently, it blew out to 12 in the US. And a shocking 18 in London. When you see numbers like that, it's not just a small market move. It's a signal that lenders are hitting the panic button. The entire credit system, the very lifeblood of our economy, is starting to freeze up. So, why is this happening now? We're staring down the barrel of a massive global debt pile, a staggering $315 trillion. For over a decade, companies got used to a world of free money. They borrowed and borrowed, rolling over their debt at near zero interest rates. It was a party that seemed like it would never end. But the music has stopped. Interest rates have shot up, and all those zombie companies, the ones that were only surviving because debt was cheap, are now facing a brutal reality. They can't refinance. They can't afford the new, higher payments. A wave of defaults isn't just possible anymore, it's becoming inevitable. This is what a credit market seizure looks like in its early stages. For the last 15 years, we lived in a bizarre financial wonderland. With inflation higher than interest rates, we had what's called negative real interest rates. In simple terms, you were effectively getting paid to borrow money. The debt you took on was worth less and less over time. This encouraged massive speculation and propped up business models that were, frankly, unsustainable. But that era is over. We've now shifted to positive real interest rates. For the first time in a long time, debt has a real cost. It's a heavy weight that has to be paid back with actual productivity and real profits. The problem is, many companies and even entire sectors of the economy are not built for this new reality. They're leveraged to the hilt, and now that the cost of that leverage is real, the whole house of cards is starting to wobble. If this all feels vaguely familiar, it should. History gives us some stark warnings. Look back at the Great Depression. It wasn't just a stock market crash, it was a devastating credit crunch that brought the global economy to its knees. Or think about the 1970s, the era of stagflation, where both inflation and unemployment were high. In both of those periods, traditional financial assets like stocks and bonds got crushed. People who had all their wealth in paper assets saw it evaporate. The system they trusted failed to protect them. The lesson is clear. When the credit system breaks, the old rules of investing go out the window. Relying on the same strategies that worked during the boom is a recipe for disaster. So, what does this mean for you and your money? It means it's time to think differently, to think defensively. The game has changed, and your strategy needs to change with it. This isn't about panicking, it's about being prepared. Those who saw the writing on the wall in the 1930s and 1970s didn't just survive, they thrived. They understood that in times of financial turmoil, you have to move your wealth from counterparty risk to real, tangible assets. They moved into things they could touch, things that couldn't be printed or defaulted on. They moved into hard assets and gold. And while their neighbors who held stocks and bonds were wiped out, they preserved their capital and were in a prime position to buy up incredible assets for pennies on the dollar when the dust settled. We are facing a similar turning point today. Let's break down a practical strategy for navigating what's coming. This is about making smart, asymmetric plays where the potential upside is far greater than the downside. First, you need to get out of highly leveraged companies. Look at their balance sheets. If they're drowning in debt, they're a ticking time bomb. Instead, focus on deep value. These are high-quality, fundamentally sound businesses that are being unfairly punished by the market panic. They might be in distressed sectors, but they have strong balance sheets and real cash flow. When the market turns, these are the companies that will soar. Think of it as finding diamonds in the rough. Second, you need to hedge against the very thing that's causing this crisis: inflation and currency debasement. This means owning inflation-leveraged hard assets. I'm talking about things that do well when the value of money goes down. Energy is a huge one. Oil and gas producers, especially those with low debt, are poised to do incredibly well. Productive land, like farmland, is another classic store of value that provides real returns. These aren't just paper promises, they are tangible assets that are essential to the real economy. They provide a powerful shield against the financial chaos that's unfolding. Finally, and this is perhaps the most crucial part, you need to own physical gold and silver. I'm not talking about paper gold, ETFs, or mining stocks, which come with their own set of risks. I mean the actual, physical metal that you can hold in your hand. And it's critical that you store it outside the traditional banking system. Why? Because when a credit crisis hits, the banking system itself becomes the source of risk. We saw this in 2008, and the next crisis could be far worse. Having a portion of your wealth, say 10 to 15%, in physical precious metals held in a secure, private vault is your ultimate insurance policy. It's the bedrock of wealth preservation that has proven itself for thousands of years. It's not about getting rich quick, it's about making sure you don't get poor quick. Putting it all together, the message is simple. The era of easy money is over. The warning signs from the credit markets are undeniable. This is a time for caution, but also a time of incredible opportunity for those who are prepared. Divest from the over-leveraged and speculative parts of the market. Shift your focus to deep value, inflation-proof hard assets, and a solid foundation of physical gold and silver stored safely. By taking these steps, you're not just protecting yourself from the coming storm, you're positioning yourself to build real, lasting wealth on the other side. Don't be a victim of the next crisis. Be one of the few who sees it coming and takes action. Thanks for watching. And be sure to subscribe for more updates as this situation develops. Stay safe out there.